What's up guys, Girolamo, Aloe here, founder of Profit Me Finance Analytics. And today I want to talk about how the overextended and the underextended financial instruments in a group can affect the strength or the weakness of this group. In particular, we have groups that are the sectors and the industries in the stocks market, so we have also the Forex subdivisions and many others. We need to have clear that a strong financial instrument is a financial instrument that is advancing, and the weak financial instrument is a financial instrument that is declining. These are the basic. So we have to consider the strength of the price. The price can be above of the trend, running far away from the trend. The price can be below the trend, going far away from the trend. Going far away from the trend, above the trend, the price is stronger than the trend. And going far away from the trend, below the trend, the price is weaker than the trend. So the group can be strong or weak according with the strength and the weakness of the financial instrument that this group is collecting. So if there are too many financial instruments that are strong, the group will tend to be strong. If there are too many financial instruments that are weak, the group will tend to be weak. And then we have to consider that a strong industry, a strong sector, a strong subdivision for the Forex, a strong group shows just a prevalence of strong financial instruments. In the same way, a weak industry, a weak group shows a prevalence of financial instruments that are weak. In the same way, you have to consider if these financial instruments are overextended or underextended. Then you have to consider if this overextension of this underextension is able to affect the strength or the weakness of the group of financial instruments that you are analyzing. Then you consider the prevalence of those financial instruments that are overextended and the prevalence of those financial instruments that are underextended. Then you can classify and categorize the group of this financial instrument, the industry, the sector, the Forex, subdivision, and so on. The group can be strong because it shows a prevalence of strong financial instruments. But the group can be also underextended because this shows a prevalence of underextended financial instruments. These affect the strength of the group. I mean, you have a group that is strong, but this shows a prevalence of underextended financial instruments. This means that the financial instruments that are underextended are financial instruments that are tending to become climatic, and then you get that a climatic point causes, in any case, a reaction wave. In the same way, if you have a strong group, and this shows a prevalence of overextended financial instrument in that group, this is something that causes a slowdown of the strength. So you have now tools to give a classification of the groups. You have a strong group that shows a prevalence of overextended financial instrument. This means that the strength of this group is going to decrease because the overextended financial instruments are tending to mark a climatic point, and this is going to cause a reaction wave. So the strong price is going to decrease, and then the strength of the entire group is going to decrease too. The same way, if you have a strong group and you have a prevalence of underextended financial instruments, this underextended deviation is going to cause an increasing of the strength of the group because the group is strong and there are too many underextended financial instruments. This is something that causes a throwback, and the throwback just increases the strength of that group, at least for a moment. In the same way, we have a weak group that shows a prevalence of overextended financial instrument into that group. This is something that causes the increasing of the weakness of the group because the overextended price in many financial instruments is something that's going to mark a climatic point. The climatic point causes a reaction wave, and then the reaction wave shows the weakening of the strength of this financial instrument. The weak industry increases its weakness. In the same way, we have also a weak industry that shows a prevalence of oversold, of underextended financial instrument. This is something that causes slowdown on the industry. So the weakness of the industry decreases because the underextended financial instruments tend to become climatic, and the climatic causes a reaction wave, and this throwback decreases the weakness of the entire industry, of the entire group of financial instruments. This is a logic that you can use to analyze concretely sectors and industries in the stock market, and also Forex subdivisions. Analyze also equities ETF that just track the equities, ETF that track Forex, and so on, and many other things. So guys, I hope that this can clarify the relation that we have between the financial instruments and the comparative relative strength. So guys, if you have questions, please contact me. I will try to give you much more explanation. And if you want to understand more, please join on Profit Me. Thank you guys for listening to my words. Thank you to be here, and see you on Profit Me. Bye.